Is Main Street Capital a good buy right now? That is the question that's probably on your mind if you've clicked on this video. Let's dive right in. Main Street Capital, listed on the New York Stock Exchange as Main, is a business development company that has been turning heads, especially with its recent performance. In the second quarter of the fiscal year 2023, Main Street Capital saw a significant increase in its net investment income. This was largely driven by higher gross interest income, dividend income, and fee income. And let's not forget its impressive yield of nearly 7.1%. But as with any investment, it's not all sunshine and rainbows. Main Street Capital also experienced higher interest expenses and other cost increases. So, is it the right time to invest in Main Street Capital? Stay tuned as we delve deeper into the financials and potential risks associated with Main Street Capital. Let's dive into the financials. In its second quarter of the 2023 fiscal year, Main Street Capital's net investment income saw significant growth. This increase was fueled by a robust rise in gross interest income, augmented by a healthy uptick in dividend income and fee income. Now let's break that down a bit. Gross interest income is the total amount of interest earned before deductions for expenses or allowances for bad debts. It's essentially the raw income generated from the company's lending activities. In Main Street Capital's case, this has seen a substantial increase, suggesting that the company's investments are yielding more interest than before. Dividend income is the company's share of profits from investments in other companies, distributed as dividends. It's a good sign that dividend income is on the rise, indicating that the companies in Main Street Capital's portfolio are profitable enough to pay dividends. Fee income, on the other hand, is the revenue earned from services provided to portfolio companies, such as management and advisory services. An increase in fee income implies that Main Street Capital is not only investing in companies, but also offering valuable services to these companies, creating an additional income stream. But it's not all rosy. The company also encountered higher interest expenses and other cost increases. Interest expenses are the costs of borrowing money, and an increase in these expenses could indicate that the company is taking on more debt. Other cost increases could relate to operational costs, which can eat into profits if not carefully managed. Despite these increased costs, the overall financial performance of Main Street Capital has been positive. The company's ability to grow its income streams, even in the face of rising costs, is a testament to its robust financial management. But as with any investment, it's crucial to keep an eye on these metrics to ensure continued financial health. But as with any investment, there are potential risks. Let's take a look at some of the industry risks for Main Street Capital. The looming specter of higher interest rates could pose a significant threat. Higher rates might burden the portfolio companies, potentially making it more challenging for them to meet their commitments. This is a key risk, especially considering the increasing effective yield on Main Street Capital's investments. You see, an increasing yield indicates that the portfolio companies are paying more, but the question remains, can they keep up? It's a bit like a tightrope walker performing without a safety net. The higher the rope, the greater the risk. Now, while the overall financial health of these companies appears solid today, a sudden spike in interest rates could upset the balance, leading to a decline in profitability. It's akin to a domino effect. One company struggles, and it could potentially impact the whole portfolio. Therefore, it's vital for investors to closely monitor these metrics. This is where the adage, "Don't put all your eggs in one basket," rings true. Diversification can be an investor's best friend when navigating the unpredictable tides of the financial markets. Now let's talk about Main Street Capital's business moat and dividend yield. A business moat, for those who aren't familiar, is a company's ability to maintain competitive advantages over its competitors in order to protect its long-term profits and market share. Main Street Capital's moat is quite robust, thanks to its diversified portfolio and strong track record in the business development sector. Now onto the dividend yield. One of the most attractive aspects of Main Street Capital as an investment is its impressive dividend yield of 7.1%. This is a significant return, particularly in the current low interest rate environment. It's important to note that a high dividend yield can be an indicator of a company's financial health and its commitment to returning capital to its shareholders. Furthermore, Main Street Capital has a strong history of paying dividends, which shows its dedication to shareholder value. This history, combined with its robust business moat, makes it a compelling option for those looking for steady income streams. The attractive dividend yield and strong business moat make Main Street Capital an interesting prospect for investors. So, is Main Street Capital a good buy right now? We've explored the financials, which have shown promising numbers with increased net investment income. However, Higher interest expenses and other costs have also been observed. The industry risks are present, with the potential impact of rising interest rates causing some concern. It's essential to keep in mind that while Main Street Capital's effective yield has seen an increase, the ability of their portfolio companies to fulfill their commitments remains a question. The company's business moat appears to be solid, with the financial results of the portfolio companies showing a mixed but fundamentally strong picture. The dividend yield is nearly 7.1%, which is quite attractive for investors seeking regular income. While the company has shown positive financial performance and offers an attractive dividend yield, it's important for investors to consider the potential industry risks and monitor the company's performance closely.